Hello and welcome to Eagles Flight University. This is a series intended for the passive investor and to help you understand what is all involved with being a good LP and what you need to know. Joining me today, and I'm privileged to be joined by my good friend Yonah Weiss. Yonah is an incredible cost segregation expert, really top of the game, and really privileged to have him on. Yonah, thank you for joining us today.
It's my pleasure. Thanks so much for having me on the show.
Absolutely. Well, Yonah, first and foremost, I have to ask, how on earth did you get involved in cost segregation before we get into the weeds of what it actually is?
Well, it's funny you ask. It was not a planned career, transition, but I had been involved in real estate for a few years and was introduced to this company, Madison Specs. I was open to an opportunity at the time, and it just seemed like a good fit. I didn't really know much about cost segregation before I started working with them. And to my surprise at the time, and no longer surprise, but to my surprise, I found that almost everyone else that I knew in the real estate world also didn't really know much about cost segregation. So I saw really quickly that there was a huge opportunity for education on this subject. And really, that's my background, having been a teacher for 15 years. I figured, hey, this might be the right fit for me.
That's excellent. And, just as a historical artifact, it seems like cost seg really became a thing more in like mid 2010 plus. It didn't seem like I heard much about it before that. Is that about right about that?
So cost seg has been around and in various forms since the 80s, with the big tax reform in the Reagan administration. But it was not really available for many people before maybe 2010, as you say, because there were only very large accounting firms that were doing it. Our company, Madison Specs, opened up in 2005, and that was one of the first kind of spin-off cost segregation companies that we had spun off from a large accounting firm, and there, like I said, it wasn't available to like the average retail investor. It was more for kind of the big corporations and the big players. And likely, so it's funny, there's actually a Journal of Accountancy article that floats around from time to time. If you Google cost segregation, like you'll come across this article from like 2003 or 2005 or something. And it says in there, like, cost segregation is something that can only be done for large commercial properties because it's very costly and it can cost like, $20,000, $30,000, $40,000 to do. And so that maybe was the sign of the times. And nowadays we're talking, a decade and a half later or more, it's a fraction of that cost and really has been opened up to everyone and everywhere.
And I guess before I get too geeked out on this, I guess I should slow down for the folks at home. What is cost segregation and how does it relate to commercial real estate?
Cost segregation is a name for a tax deduction, for an income tax deduction. It's really an advanced form of depreciation. So anytime you buy a property, besides for your primary residence, if it's an investment or business property, you're able to take this depreciation deduction, which essentially says that your property is going down in value when it's actually not. So it's just a borrowed term that the IRS says, we're going to give you this deduction based on the principle that things go down in value, as if your property is going down in value. You can write off that reduced value, even though it may be going up in value. Now, that depreciation deduction is based on your purchase price, and it's subjective to the property owner. Again, subjective, not based on the actual property. So even if the property was built in 1925, you can start your depreciation schedule, which is over a 27.5-year period for residential properties, the day that you buy the property. So anytime the property changes hands, the new owner can start their depreciation schedule over fresh. And so that's what depreciation is. So it's essentially taking a small deduction over a long period of time. And cost segregation is a way to break down the property into its components. And so it used to be called component depreciation, but essentially what we're doing is, from an engineering perspective, we're segregating the cost. Okay, we're breaking down the purchase price of the building into different categories or different components, like furniture and fixtures, and window treatments and flooring and cabinets and counters. All that stuff actually depreciates on a 5-year schedule. And so by identifying what those items are, we can then take a tax deduction of the value of those items at a faster rate, essentially creating more cash flow in the early years of ownership.
And Yonah, just kind of to slow that down a little bit. So historically, you would take the entire depreciation of the entire building and everything all in one shoot, and basically either the 27 or 39 for commercial, right? So that's the big difference is we're, instead of lumping it all in that big lump, we're going to like create subclasses of different components, and therefore you get the different schedule.
Right. Yeah. So it's, instead of lumping everything together and taking a little deduction, equal amount, 2 to 3% of the value of the property every single year, you're able to front load a certain portion, sometimes 20 or 30% of the total depreciation into the first year or the first few years of ownership. And so getting bigger deductions up front.
And I guess for people that are trying to decide whether it's a good idea or not, what are the cases where cost segregation might not be a good idea, or something you shouldn't do it, or what are the cases where it's like, that's maybe not something you want to do?
So it really is dependent more on the property, more so on the property, value. So if it's purchased for over, I'd say $200,000-$300,000, any property is worthwhile looking at, because the percentage of depreciation you can accelerate is, again, it's usually on average about 20-25% of that purchase price. So the value is really there. But even more important than the actual property is the person or the owners of that property who can benefit from cost segregation. And so certain people can actually benefit more than others when it comes to using those depreciation deductions. The most important thing to understand when it comes to depreciation deductions and using them is that passive income, rental income, is treated differently than other types of income. And depreciation is considered a passive deduction, which means you can only use this depreciation, this cost segregation deduction, to offset your passive income or your rental income or other passive gains from the sale of real estate. So a lot of people have this misnomer in thinking, oh, if I'm just going to invest in real estate, I can, do cost segregation and then I'll wipe out my whole W-2. I won't have to pay any taxes on anything whatsoever. And unfortunately, that's not the case. And so it's really important to know who's going to be owning the property, who's going to be benefiting, and to what extent.
Unless your spouse can qualify for, tax professional status?
Right. Unless you or your spouse qualify for what's called real estate professional status. And that's a special rule in the tax code that says that if you or your spouse are full-time in the real estate trade or business, you can actually use these deductions, this depreciation, against your active income or any other source of income as well. And so, yes, there are people, and I highly recommend this if you are an investor, that if you can't be full-time in real estate and you're serious about taking advantage of the tax code, then you make sure your spouse is, right? Maybe start a dating app or something to match high W-2s, right?
High W-2s with real estate pros or something like that. Realestatematch.com or something like that. Absolutely. It's it's one of the greatest tax code. Well, it's not a cheat. It's legit. I mean, it's just one of the greatest features of the real estate tax system. It's really fascinating.
Yeah, absolutely.
And Yonah, I'm really fascinated by the concept, and you've said some of the best things about recapture I've seen. Some people deem recapture as like a really bad thing. It's, it gets recaptured anyway. Why, what's the big deal? Can you talk a little bit about the issue of the recapture and how that goes?
Absolutely. Anytime you sell an investment property, anytime you sell a property, you're going to be subject to a tax called depreciation recapture tax, which means the amount of depreciation you took, you're going to be taxed or subject to a tax on that amount. It doesn't mean that you're going to pay back the amount of depreciation you took. It just means you're going to be taxed on that amount. Now, there are ways to further defer that tax, like with a 1031 exchange or other deferral methods, or to reduce that tax, right? Like if you, as I mentioned earlier, using depreciation can be used to offset not only your passive income, but also passive gains. And this depreciation recapture tax, along with the capital gain tax on the sale, is considered a passive gain, meaning you may have essentially the sale of a property is going to produce a big gain. And then if you buy another property in the same year and do a cost segregation, you could essentially use those losses to offset those gains. And so essentially, you won't necessarily pay any tax on that recapture. Now, there's a kind of complicated, there's about 4 different ways to calculate recapture tax. So it's not one simple, straightforward method. There's actually 3 different types of property anytime you buy a property. And without getting into the nitty gritty of the tax code or the different sections of the code, the main portion of your property, which is going to be your structural components, that's going to be recapture tax on at the highest of over a 25% rate. Okay, then there are other components that you may accelerate depreciation of that are going to be taxed at your ordinary income tax rates, which may be higher than 25%, depending on what your ordinary income tax rate is. Without getting too complicated, usually by doing a cost segregation study, you're going to be saving money on taxes regardless, because the tax you'll pay on the recapture on the sale is going to be a lower rate overall, a lower blended rate than had you not taken those deductions at all.
And Yonah, when it comes to an LP, is there something they should be on the lookout for that maybe the GP team, because sometimes all GPs are not created, I'm just going to be direct about that. All GPs are not created, have some of different varying levels of savvy. Is there something they should be on the lookout for? Like even asking the question, hey, are you doing a cost study, might separate the wheat from the chaff possibly?
Yeah, and in fact, probably one of the most important questions, if you are asking. Now, there are GPs that are going to advertise that they're getting a cost segregation study, bonus depreciation. They may even try to put in a number there that will reflect what the potential, taxes you're going to be saving, which most of the time I've seen those numbers, they're wrong, or just vague, and it does not reflect reality. But that being said, an important question to ask is, well, what's the hold period? Like, how long are we planning on holding this property for? What is the percentage? Are the GPs taking a percentage of the depreciation as well? And that can be in the operating agreement if they're getting allocated a certain portion of that depreciation, or all the depreciation is being passed on to the investors. Again, if you are not a real estate professional, then, or your spouse, then those depreciation deductions you'll get from cost seg are going to be great in terms of you're not going to be paying income tax on any of the income being produced by that investment or any other, property. So that's a really good thing. However, to spill over to other types of investments or other types of income, it's usually not the case. And so it's important to understand how long is the hold period, because if it's a short hold period, like let's say less than 2 years, that recapture tax is going to come in a short period of time. And therefore, the time value of money of using those deductions is going to be much less. And so those are a couple really important questions to ask. And again, find out if the depreciation is being diluted at all from the investors. And in certain cases, it is. So just, again, make sure to read your operating agreements and find that out.
And Yonah, is there any questions that if you were an LP that aside from that, is there anything else they need to look out for? I just really want to make sure they get good coverage on that.
Yeah, absolutely. I mean, in the end of the day, cost segregation is a very powerful tool for real estate investors to help reduce their tax liability. And, there's almost no other investment vehicle out there that you can get a deduction, get this kind of strategy, and not pay taxes on that income that you're making from the investment. And so going into investment and seeking out, is this something that the sponsors are doing? Is this something that the GP team is doing is important to know, and make sure that they're doing it with a professional company, make sure they're doing it the right way. And to understand also that there's an accounting team or a CPA team that's going to be, sending out those K1s to all the investors. That's going to reflect the amount of depreciation that you're going to be able to get. I've heard, unfortunately, I've been in this business for a while, and I've heard some stories and nightmares, if you will, where it just didn't happen. People being held up and not getting their K1s in time to file their taxes and things like that. And it's just unfortunate.
Yeah, it seems like timeliness of K1s, or it seems like an endemic problem in the business. It seems like we should be able to fix that problem. It happens way too much, it seems to me, but I'm not sure what that's about. It is definitely a thing. Definitely a thing. Speaking of K1s, I'm on a hunt for the mythical person, unicorn, or leprechaun, or some entity that can explain all the boxes of K1. Have you met anyone who understands what all the boxes of a K1 are?
I have spoken. I personally cannot say that I understand and use all the ins and outs of that, but I have spoken with and know quite a few CPAs that are very well versed in that. So make sure you have a good CPA who understands real estate.
Absolutely. Well, Yonah, thank you so much for the time today. Fantastic overview of the entire process of COSEG, and thank you so much for joining us. Yonah, where do we reach you if someone wants to reach out and pursue COSEG with you or your firm? How do we reach out to you?
Well, you can find me on LinkedIn. That's the most active place I am. Twitter or any other social media, or you can just go to yonahweiss.com.
Excellent. And guys, I will put Yonah's LinkedIn profile in the notes with the YouTube channel here. And once again, Yonah, thank you so much for joining us.
It's really been a pleasure. Thanks so much.
You bet.